In Austin, Texas, you need a $180,000 salary to afford a median home. The actual median salary? $78,000. That's not sustainable math. That's a bubble waiting to burst. Austin isn't alone. I've identified 10 cities where this dangerous disconnect between wages and housing costs has reached breaking point levels. This isn't about predicting a 2008-style global meltdown. The lending standards are different. This is about identifying localized, regional bubbles poised for a painful correction. My analysis focused on 3 key warning signs. First, a dangerously high price-to-income ratio. Second, a surge in investor activity. And third, a rapid increase in housing inventory. Using data from the Federal Reserve, Moody's Analytics, and the National Association of Realtors, I've compiled a list of the 10 cities showing the most significant red flags for 2026. Let's begin our countdown. The first city on our watch list, coming in at number 10, is a place that became the poster child for the pandemic-era boom: Austin, Texas. Austin's story is one of incredible growth, fueled by a massive influx of tech companies and high-paid remote workers. But this success came at a steep price for its housing market. Between 2020 and its peak in 2022, the median home price in Austin skyrocketed by over 70%, according to data from the Austin Board of Realtors. Wages did not keep pace. This pushed the city's price-to-income ratio to a peak of nearly 9. Historically, a ratio above 5 is considered a significant warning sign of an overvalued market. What I found particularly concerning was the nature of the buying. A significant portion was driven by investors and out-of-state cash, not local families looking for a primary residence. The risk here is clear. When the tech hiring boom slows, or if remote work policies shift, the external demand that inflated these prices could evaporate very quickly. We're already seeing the early signs. As of late 2024, housing inventory in Austin has swelled to its highest level in over a decade. More supply and steady demand means prices must fall. From the Sunbelt to the desert, our 9th city is a place with a long history of boom and bust cycles. Its latest boom was one of the most intense in the nation: Phoenix, Arizona. Phoenix's housing market was supercharged by a phenomenon known as iBuying. Companies like Opendoor and OfferPad bought up thousands of homes, often sight unseen, fueling a speculative frenzy. This, combined with a flood of investor capital, created an artificial sense of scarcity. According to a CoreLogic report, investors accounted for nearly 1 in 3 home purchases at the peak. This creates an incredibly fragile market. Unlike a family, an investor has no emotional attachment to a property. If prices start to dip, they are the first to sell, flooding the market. And that's exactly what my research indicates is happening. As iBuyers pulled back and interest rates rose, inventory in the Phoenix metro area more than tripled from its 2021 lows. The underlying economic risk for Phoenix is also significant. Long-term water security issues, as documented by the Arizona Department of Water Resources, cast a shadow over future growth. This isn't just an environmental issue, it's an economic one. It could restrict future construction and increase the cost of living, making the area less attractive over the long term. The combination of speculative mania, surging inventory, and long-term environmental risks puts Phoenix in a precarious position for a significant market correction by 2026. Our 8th city takes us from major Sunbelt hubs to a smaller city that became the symbol of the Zoomtown phenomenon. Let's head north to Boise, Idaho. Boise's story is perhaps the most dramatic example of a housing market completely reshaped by an external force: the mass migration of high-income remote workers from coastal states. I analyzed migration data from Redfin, and the numbers were staggering. This influx of cash pushed Boise's median home price up by over 80% in just 2.5 years. The problem is, local wages couldn't come close to matching that climb. Boise's price-to-income ratio ballooned from a healthy 4 to a bubble territory 8.5 at its peak. This created a 2-tiered city. You have the new, high-earning remote workers, and then you have the long-term local residents, teachers, firefighters, service workers, who are now completely priced out. The primary risk for a market like Boise is its extreme vulnerability to shifts in the national economy and corporate policy. Its fate is no longer in its own hands. A tech recession or a widespread return-to-office mandate would pull the rug out from under the market. The high-paying jobs that inflated prices would simply vanish from the local economy. Unlike Austin, Boise's local economy is not large or diverse enough to absorb such a shock. A correction here wouldn't just be a dip. It could be a sharp and prolonged downturn. Moving from the mountains to the coast, our seventh city is a vacation paradise that saw an unprecedented rush of speculative investment. Number 7 is Myrtle Beach, South Carolina. Myrtle Beach has always been a popular tourist destination, but the pandemic-era search for affordable coastal living turned its market into a pressure cooker. What I found when digging into Census Bureau data was a massive surge in the construction of new multifamily units and condos, far outpacing historical norms. A significant portion of these properties were bought by out-of-state investors intending to use them as short-term rentals on Airbnb and VRBO. This creates dual risk. First, depending on tourism industry health, a recession curbing travel spending would hit hard. Second, it makes housing vulnerable to regulatory changes. Many cities are cracking down on short-term rentals. If Myrtle Beach implemented stricter rules, hundreds of investor-owned condos could flood the market simultaneously, causing a crash. The economy is reliant on lower-wage hospitality jobs. Property prices are disconnected from local workforce incomes. Our number 6 city has long struggled with affordability, but recent trends pushed it into dangerous territory. Let's head to San Diego, California. You might think California is always expensive, but my analysis shows this situation has become untenable. San Diego has one of the highest price-to-income ratios nationally, often exceeding 10, double what's considered overvalued. Traditional homeownership is mathematically impossible for median earners, including nurses, police officers, and teachers. What's holding prices up? Severe supply shortage and reliance on high-income biotech jobs, plus military personnel. The risk? These pillars aren't stable. Biotech faces funding cycles. Military populations shift with federal decisions. Census data reveals more people leaving San Diego County than moving in due to unaffordability. When a city becomes so expensive its workforce must leave, it's a red flag. This population drain erodes tax base and reduces demand. San Diego is primed for a value reset, a 15 to 20% price drop to realign with economic fundamentals. Now for a city whose recent boom has been both staggering and, according to data, dangerously fragile. At number 5, we head to Miami, Florida. Miami has been on an absolute tear, repositioning itself as a global hub for finance and crypto, attracting high-net-worth individuals and investment firms. This Wall Street South narrative fueled a massive run-up in luxury condo prices. But when I looked at Moody's Analytics data, I saw a familiar and dangerous pattern. The market is disproportionately reliant on external cash and volatile industries like crypto. The local wage economy, heavily based on tourism and services, has been left far behind. The biggest red flag, however, is not economic, but existential. Rising costs and risks from climate change are becoming impossible for the market to ignore. Major credit agencies and insurers are now explicitly pricing in hurricane and flood risk. This has caused property insurance premiums to skyrocket. In some cases, insurance costs are becoming as high as the mortgage payment itself. This is a fundamental threat to property values. If you can't insure a home, you can't get a mortgage. This isn't a distant threat, it's happening now. The combination of a speculative luxury bubble and soaring, non-negotiable ownership costs makes Miami's market one of the most vulnerable in the country. For our 4th city, we head to a region not typically linked with housing bubbles, but one that saw an intense run-up driven by similar forces. Number 4 is Nashville, Tennessee. Nashville's brand as a vibrant cultural hub and IT city attracted a flood of new residents and, critically, huge investor capital aimed at short-term rentals. When I analyzed building permit data from the city's metro government, the trend was unmistakable. A boom in construction of tall, skinny homes and multi-unit properties in traditionally single-family neighborhoods, built explicitly for Airbnb. According to AirDNA, a short-term rental analytics firm, Nashville became one of the most saturated markets in the country. This investor-led demand pushed prices to levels that became disconnected from local incomes. The city's affordability crisis is now a major political issue, documented extensively by the Tennessean. The primary risk here is identical to Myrtle Beach, but perhaps even more acute: regulatory action. The City Council has been actively debating much stricter controls on non-owner-occupied rentals. If a restrictive policy passes, the business model for thousands of properties would collapse overnight. Investors would rush for the exits, creating a supply shock that would crater prices. The local economy, while growing, has not produced the high-wage job growth seen in places like Austin. This makes the housing market's high valuations particularly suspect and fragile. Now, we enter the top 3. These are cities where, according to my analysis, the warning signs are not just present, but flashing bright red. At number 3, we head back to the Mountain West, Reno, Nevada. Reno's story is one of spillover. As California became increasingly unaffordable and tech giants like Tesla built massive facilities nearby, Reno transformed into a major destination. This created a perfect storm. You had an influx of high-earning California equity refugees cashing out and buying in Reno, combined with new, high-paying jobs from the industrial boom. The result was one of the fastest rates of home price appreciation in the country. Data from the Federal Housing Finance Agency shows prices in the Reno area nearly doubled in just a few years. The problem is the scale. Reno's housing stock and infrastructure were not prepared for this onslaught of demand. The market became severely imbalanced, with frantic bidding wars becoming the norm. The key risk here is economic concentration. The region's newfound prosperity is heavily tied to the fortunes of a few very large companies, primarily Tesla. Any slowdown in electric vehicle demand or a shift in corporate strategy could have an outsized negative impact on the local job market, and consequently, on housing demand. Furthermore, the California spillover effect is a double-edged sword. When California's housing market cools, as it has been, the flow of equity-rich buyers into Reno slows to a trickle. Reno's boom was fueled by external forces it couldn't control. Now, its potential bust will be dictated by those same external forces, leaving it in a highly vulnerable position. The runner-up for the city, most at risk of a housing crash, is a place that combines several of the risk factors we've already discussed into one potent mix. Number 2 is Tampa, Florida. Tampa's housing market became one of the hottest in the nation post-pandemic. I analyzed Zillow's data, and at its peak, home values were appreciating at a rate of over 30% year over year. This rapid increase was driven by a combination of strong migration from other states, a surge in investor buying, and a general fear of missing out that gripped the market. The result is a market that, according to a study by Florida Atlantic University, became one of the most overvalued in the entire country, with homes selling for a 50 to 60% premium above their long-term trend line. This level of overvaluation is historically unsustainable. What makes Tampa particularly vulnerable, however, is the same factor we saw in Miami, the insurance crisis. As major insurers pull out of Florida or drastically raise rates due to hurricane risk, the total cost of homeownership is exploding, even if mortgage rates come down. This completely changes the affordability calculation. A buyer might be approved for a mortgage, but then find that the $600 or $700 monthly insurance bill makes the home unaffordable. This creates a shadow inventory of homeowners who might be forced to sell, not because of their mortgage, but because they simply cannot afford the soaring carrying costs of their property. Tampa represents a market where speculative fever met a hard, unchangeable reality. The extreme overvaluation combined with the insurance crisis creates a recipe for a severe correction. And that brings us to number 1. After analyzing data from dozens of metro areas, one city consistently emerged with the most severe combination of risk factors. This city experienced one of the most extreme pandemic-era booms, has a dangerously high price-to-income ratio, significant investor saturation. The number 1 city most at risk of a housing crash by 2026 is Salt Lake City, Utah. Now, this may be a surprise. Utah has one of the strongest economies in the nation, but it's that very success that created the conditions for one of the country's most severe housing bubbles. For years, Salt Lake was an affordable alternative to places like Denver. But a booming tech sector, the Silicon Slopes, and a massive influx of new residents changed everything, very quickly. Home prices in the Salt Lake metro more than doubled between 2018 and 2022, according to the Salt Lake Board of Realtors. This was one of the most rapid price gains in the entire country. This created an extreme affordability crisis. I cross-referenced home prices with local wage data from the BLS, and the gap became a chasm. The price-to-income ratio soared to nearly 9. What makes this situation particularly dangerous is the role of interest rates. Utah has the youngest median age in the country, meaning many recent homebuyers are young families. Many of these families stretch their budgets to the absolute limit to buy a home at the peak, often with low 3% mortgage rates. They are now rate-locked in historically expensive properties. The market has now hit a wall. With mortgage rates doubling, the pool of eligible buyers has shrunk dramatically. I looked at sales data, and the volume has plummeted. Inventory is piling up. Developers who bet on continued exponential growth are now sitting on hundreds of newly finished but unsold homes. This is a classic bubble scenario, a price run-up fueled by low rates and FOMO, followed by a sharp rate increase. The strong Utah economy might soften the landing, but it cannot defy gravity. The sheer level of overvaluation suggests Salt Lake City is positioned for the most significant price correction. So let's quickly recap our top 5 most at-risk cities. Miami, with its insurance crisis. Nashville and its reliance on short-term rentals. Reno, a boomtown tied to a single industry. Tampa, combining extreme overvaluation with the insurance time bomb. And finally, Salt Lake City, the poster child for a classic rate-induced housing bubble. As I analyzed these markets, I began to see that not all housing bubbles are created equal. They fall into distinct categories, each with its own specific set of risks. The first type I call the speculative frenzy. These are cities like Phoenix and Nashville. The bubble here was inflated by a massive influx of investor capital, often for short-term gains. The risk in these markets is behavioral. Investors are not long-term residents. When sentiment shifts, they sell in unison, creating a stampede for the exit that can crash prices quickly. The second archetype is the Zoomtown bubble. This is Boise, and to some extent, Reno. Their markets were warped by an external force, the sudden arrival of high-income remote workers. These markets are incredibly fragile because their fate is tied to corporate policies made 1,000 miles away. A widespread return-to-office mandate is their greatest threat. The third archetype is what I call the affordability crisis bubble. This category includes San Diego, Austin, and Salt Lake City. Here, prices simply outran local wages to an extreme degree. The correction in these cities is a simple, painful math problem. Prices must come down to a level where the local workforce can actually afford to buy, or the city ceases to function. Finally, you have a unique category for the Florida cities, Tampa and Miami. I'd call it the existential risk bubble, where a fundamental threat, climate-driven insurance costs, is actively eroding value. Understanding which type of bubble a city is helps predict how a correction might unfold. A speculative bust can be fast and brutal. An affordability reset may be a slower, grinding decline. Now, you might be wondering about other major cities. What about places like Denver, Seattle, or Dallas? My analysis showed that while they face affordability challenges, they lack the acute risk factors of our top 10. Denver and Seattle, for instance, saw their major price run-ups earlier. Their markets have had more time to cool, and their economies are more diversified than a place like Reno or Boise. Dallas, while experiencing strong growth, has a key advantage: the ability to build. Unlike geographically constrained cities, Dallas can continue to expand outward, which helps moderate price extremes. So, we've identified the cities and the types of risk. But what does this mean for you, whether you're a homeowner, a potential buyer, or a renter? If you're a homeowner in one of these high-risk cities who bought recently, the worst thing you can do is panic sell into a falling market. If your payment is affordable, your best bet is often to ride it out. Remember, a paper loss on your home's value only becomes a real loss if you sell. The real danger is for those who are over-leveraged or may be forced to move for a job. For potential homebuyers, this information is a powerful tool for patience. The fear of missing out, or FOMO, that drove the market up is now being replaced by the fear of buying at the top. The key is to do your own hyperlocal research. Don't just look at the city's median price. Analyze the inventory levels and price cuts in the specific neighborhood you're interested in. A rising number of price cuts is the first sign that sellers are losing leverage and the market is shifting in your favor. This is the data point that precedes an actual drop in sale prices. I highly recommend tracking a metric called the sales to list price ratio. When homes are consistently selling for less than their asking price, the bubble is actively deflating. And for renters, a housing market correction can be a double-edged sword. In the short term, as buyer demand cools, more homes may hit the rental market, which can stabilize or even lower rent prices. However, if a correction leads to a slowdown in new construction, the long-term rental supply could tighten, eventually pushing rents back up. It's a complex dynamic to watch. Beyond the individual level, what are the bigger picture signs to look for? I believe the first major indicator will be the behavior of institutional investors and iBuying companies. When these large-scale players, who have the most sophisticated data, completely halt purchasing in a market and begin to slowly offload their inventory, that's a 5-alarm fire drill. Another key national indicator is the delinquency rate on commercial real estate loans, particularly for multi-family apartment developers. This data is tracked by the Federal Reserve. If developers who bet big on rising rents and property values start defaulting on their loans, it signals that the underlying economics of the rental market are cracking under pressure. Ultimately, the future of these markets depends on one fundamental question: can they transition from being speculative hotbeds to sustainable communities where local residents can afford to live. A city like Austin has to see its job growth translate into broader prosperity, not just price hikes. Boise has to build a resilient local economy that isn't dependent on remote work policies. And the Florida cities face the toughest challenge of all. They must find a way to innovate their way out of a climate-driven insurance crisis, a problem that money alone cannot solve. The era of easy money and historically low interest rates created distortions in the housing market that will take years to unwind. The Great Realignment has already begun. This isn't a forecast of doom, but a call for caution and realism. Housing is not just an asset, it's the bedrock of our communities. Its stability is essential for everyone. So, if you are looking to buy in the near future, my advice is simple. Make decisions based on 2026 realities, not 2021 memories. Ignore the hype and focus on the fundamentals. Can you comfortably afford the payment at today's rates? Is the local economy diverse and stable? And most importantly, would you be happy living in that home for the next decade, regardless of its value? If the answer to those questions is yes, then you are buying a home, not a speculative asset. And that is the soundest investment you can make in any market. The housing market is deeply personal and local. I'm curious to hear your on-the-ground perspective. Are you seeing these signs of a slowdown in your city, whether it's on this list or not? What are the specific indicators you're paying attention to? Share your story and your observations in the comments. The collective knowledge we share helps everyone navigate these uncertain times more intelligently. If you found this data-driven analysis helpful for understanding the risks in today's market, the best way you can support this channel is by liking this video and subscribing for more deep dives into the economic forces shaping our lives. Thank you for watching. Be patient, be informed, and be safe.